How do Federal Reserve stress tests determine bank capital requirements? Have you ever wondered how banks prepare for tough economic times? Federal Reserve stress tests are a key part of that preparation. These tests help ensure banks can handle financial challenges. Let's break down how these tests work and what they mean for bank capital requirements. First, the Federal Reserve creates hypothetical economic scenarios. These scenarios often include severe recession conditions. The goal is to see how banks would perform under stress. The tests look at a 2-year period to mimic real-world economic downturns. Next, banks are assessed on their performance during these scenarios. The stress tests evaluate projected losses, revenues, expenses, and capital levels. This evaluation helps determine if a bank can maintain its capital buffers. It is essential for banks to continue lending to households and businesses, even during tough times. The results of these stress tests lead to the establishment of the stress capital buffer requirement. This requirement combines stress test results with non-stress capital requirements. The stress capital buffer ensures that banks hold enough capital to cover potential losses while meeting their obligations. Transparency is also a significant aspect of these tests. The Federal Reserve publicly discloses the results, allowing everyone to see each bank's financial health. Additionally, banks must conduct their own stress tests based on their risk profiles and share those results. From a conservative viewpoint, these stress tests serve as a necessary regulatory tool. They help maintain stability in the financial system. By demonstrating banks' ability to withstand economic shocks, they build confidence among consumers and investors. However, some conservatives argue that too much regulation could limit banks' ability to lend freely, which might hinder economic growth. While stress tests are generally seen as a prudent measure for safeguarding the banking system, there is a balance to consider. Some Republicans believe that capital requirements should not be overly stringent. They argue that excessive requirements could restrict banks' capacity to support economic growth through lending activities. Nonetheless, the primary goal of these tests aligns with conservative values of financial responsibility and stability. In summary, Federal Reserve stress tests are vital for determining bank capital requirements. They simulate adverse economic conditions, assess bank performance, and establish necessary capital buffers. This process helps ensure the resilience of banks and the overall stability of the financial system.